Inflation's at record highs around the globe. The pandemic has cost the world over $19 trillion and counting. There's war on the continent of Europe and heightened geopolitical tension around the world. Bond market volatility is at new levels and equities are going down the toilet. Global debt sits at $300 trillion and energy prices are skyrocketing to levels that are terrifying for households and businesses alike. Food shortages are leading to food riots and food prices are becoming unaffordable for more and more people around the globe. Where on earth do we turn as society, the economy, and the actual planet we live on burns down around us? Quite simply, the floor is lava. We don't claim to be able to stop the floor from burning up around you, but we can certainly navigate you to safer ground. This is the M3 Report. Coming up, we have the legend that is Mr. Jim Rogers speaking to us all the way from Singapore, and I'll be asking him more about the greatest bear market of his lifetime, as well as the worrying matter of China and America. Don't miss it. And we are delighted to welcome Patrick Karim of NorthStarBadCharts.com to give us a download of what's been happening in the markets in ChartWatch. But that's not all. Stick around to see some off-script questions we put to Mr. Rogers at the end of the show. And loyal fans amongst you, and there are many, will have spotted that we took a few weeks off for the summer break, but we didn't just leave you empty-handed, forced to watch cat videos and Dr. Pimple Popper. Instead, we handed the controls over to GoldCore newcomer Jan Scoyles. Rather than do any actual work, Jan instead decided to dig into the GoldCore archives and see what she came up with. And that was an imaginary dinner party featuring past guests from the M3 Report, Jim Rickards, David Morgan, and Mark Faber. Jan's dinner party brings you the answers to the questions that we don't usually ask. And if anyone can top David Morgan's first job or Mark Faber's biggest investment mistake, then please let us know in the comments below. Last time that we spoke, you said that the next bear market that we're going to see is going to be probably the biggest bear market of your lifetime. Now, since then, we've seen, although recently some of the indices have recovered, we've seen a greater than 20% decline in a lot of indices. We've also seen 2 quarters of negative GDP out of the US. Is this the start of that bear market that you predicted, or what will convince you that we have actually started?
Dave, how do I know? Watch GoldCore. What are you talking about? In my view, what I said was that, yes, we will have a bear market again someday. And when we do, it will be the worst in my lifetime. You remember 2008, 2009, we had a big problem. Well, because of too much debt, since then, the debt everywhere has skyrocketed. It's staggering how much the debt everywhere in the world has gone up since 2009. So it has to be the worst in my lifetime. I'm not trying to scare people. I'm just making a simple statement of fact. The debt has skyrocketed everywhere, and we always have bear markets. So the next one has to be very, very bad. Has it started yet? In my view, there's so much pessimism around that usually leads to something happening and causes a big rally. If that happens, it'll be the last rally, if you ask me. If we have peace in Ukraine, or if the Federal Reserve says, oh, we're sorry, who knows what, we'll have a big rally, and that'll probably be the last rally.
There are going to be some serious consequences. I mean, one of the things that we're seeing a lot of dollar strength, or relative dollar strength at the moment. Do you think that is caused primarily by the fact that the dollar is just currently looking like the least bad option on the street at the moment?
Well, they're all bad, but I own a lot of US dollars. And the reason I do is because when the turmoil comes, people look for a safe haven. Now, they think the dollar's a safe haven for historic reasons. It's not. It's not. We're the largest debtor nation in the history of the world. But since people think it's a safe haven, the dollar will have a big rally, might get overpriced, might turn into a bubble. I hope I'm smart enough to sell it if that happens. And your next question, Dave, should be, what are you going to do with the money then? And that's a very good question. I look every day to find out what's going to be the next competitor for the US dollar. If you know, Dave, please do not announce it. Do not announce it on the program. Send me a private email, because I'm looking every day to figure out what it's going to be. Logically, it would be the Chinese renminbi, but the Chinese currency is a blocked currency. You cannot have a world currency that's blocked. So I don't know what it's going to be.
One of the things that has happened since the last time that we spoke was the invasion of Ukraine. Now, the part of the global financial response to that has been a lot of sanctions, financial sanctions, whether that's things like sanctions through SWIFT. And it's really come across as weaponizing financial markets and weaponizing financial assets. Do you believe that that was a wise move, or do you think that there are some unintended consequences as a result of these sanctions?
Well, not for the Americans, it was absolutely insane. I'm an American, so I don't like it, doubly don't like him. But, you know, people are already looking for something to compete with the dollar because of political reasons. If Washington gets angry at you, they cut you off. Dave, that's not the way a reserve currency is supposed to be. It's supposed to be completely neutral. Anybody in the world can use it for anything. And all of a sudden, Washington says, no, 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 if we don't like you, you're in trouble. So now people are accelerating the move to find something to compete with the US dollar, because even our friends are starting to say, wait a minute, these guys could take our money away just by, you know, closing down the banks or for whatever, in whatever way or whatever reason. So no, this just accelerates the move away from the US dollar. I don't like it, Dave, but I can see what's happening. Everybody in the world say, wait a minute. These guys could cut us off at a moment's notice, so we got to have an alternative.
And one of the things that we have seen, again, since last time we spoke, the transitory inflation phrase was being bandied around a lot. That inflation has proven not to be transitory in the States or anywhere else around the world. And we're starting to see the central banks respond to that inflation problem quite aggressively. There is a risk that if this aggressive response continues, that will be a catalyst for the sustained and largest bear market that you have predicted. What, in your opinion, do you think is on the minds of central bankers? Are they more focused on tackling this inflation animal, or are they more focused on ultimately managing the economy, and as a result of that, managing the economy positively, and as a result of that, not raising rates as high as they should in order to tackle inflation?
Well, Dave, I mean, I've been around a long time, and there have been very few good central bankers in history anywhere. America's had, I can remember two in the last 50 or 60 years. India had a very good central banker 5 or 6 years ago, but he's gone now. They're just not very, these are bureaucrats. These are academics. None of these guys are very smart. All they want to do is get a government job and keep a government job. They don't care about you and me. They care about getting a nice, sweet government job. They don't know what they're doing. And yes, they will probably get it wrong. You know that a few months ago, they were saying there's no inflation. And they said, oh, well, it's transitory inflation. I mean, if you listen to these guys, or if you go back and read them throughout history, you say, oh my God, how could these? And they all have fancy Ivy League degrees. Oh, they have great Ivy League degrees, which means you should be very worried about them, because they don't know anything even more. By the way, I have some Ivy League degrees, so when I say that, I speak from experience. I speak from experience, but they will get it wrong. As I said before, maybe what will happen, you know, oil prices, grain prices have been coming down. If there's peace in Ukraine, many prices will come down. The central banks will say, see, we saved the world. And then they'll start loosening up again. They won't be so tight again. And that will lead to that rally I mentioned before, the last rally. I mean, you have to watch them, because they have certainly good influence and sometimes big influence, but do not listen to them and think they know what they're doing.
Now, obviously, you keenly follow markets on an ongoing basis, but for the average investor who doesn't follow geopolitical machinations and financial market machinations as closely as you do, or somebody like you. What would be your advice to somebody who has a traditional 60-40 equity bond portfolio that is really starting to be concerned with what's going on in the world right now and how they might weather that storm?
Well, first I would say, please forget 60-40, what you call a traditional portfolio. That's not the way to make any money. Things like that, diversification, for instance, is something that brokers come up with so they don't get sued. That's not a way to make money, though. If you want to make money, what you do is you focus, you concentrate, you put all your eggs in one basket. You got to have the right basket, but you better watch that basket very, very carefully. I mean, remember Henry Ford? He didn't diversify. He put all his monies in Ford Motor Company and got stinking rich. The guys at IBM, same thing. I could go on and on. Now, after they get rich, they start diversifying because the brokers tell them they have to. But no, if you want to get rich, find the right investments, few, and then focus and concentrate. That's how you get rich. You don't get rich diversifying, and you certainly don't get rich with a 60-40 portfolio.
That's fantastic and sage piece of advice. I want to just change tack very briefly, and I want to get your opinion on the saber rattling that we've seen between China and the US over Taiwan, and if you have any opinion on how you think that that may play out over the coming year.
Well, it's what the US is doing is insanity, if you ask me. Nancy Pelosi, I don't know what she thought she was doing to go to Taiwan. I don't know what anybody thinks they're doing, poking the Chinese in the eye. So far, the Chinese have been much more constrained or restrained than the US. Unfortunately, David, these things throughout history often wind up with a shooting war. I mean, it's madness, it's insane. The US, I don't see how the US can possibly win a shooting war over Taiwan. And if I were the Chinese, I would certainly not get in. Look at a globe. All China has to do is wait. You know, China's been around a few thousand years. Eventually, Taiwan's going to be part of China again, whether we like it or not, just because of geography, if nothing else, geography and demographics. So I would, if I were China, I would just sit and let them wait and make noise. Unfortunately, the US, I don't know, they seem to want a war over Taiwan, which I don't see how we possibly can win. I can see it nothing but madness for the US and for the world. I would like, having said that, I would like to say, no, cooler heads will prevail, but there's been it was a study recently that showed that America's been a country since 1789. In all but 15 years of that period, we've been at war with somebody. The people in Washington like war for some reason. I, of course, don't, but for some reason, those guys love war. So my bet would be, I know it should not happen. My bet it will not happen. But when things get bad throughout history, when countries have problems, the politicians blame foreigners. They always do, everywhere in the world, because foreigners have different skin, different food, different language, different religion, different everything. And it's easy to blame the foreigners. And that's how we have wars, as insane as they are. So I would say it's not going to happen, but I wouldn't bet on it, given I know that problems are going to come. And when problems come, a lot of politicians like to start blaming foreigners.
My thanks to Jim Rogers for joining me on the M3 Report. And don't forget, you can see the full interview in all its glory later on in the week. Make sure you subscribe to GoldCore TV so that you don't miss any of it. Now, it was a somber note to finish on there with Jim, but things really are getting quite scary now. As we said at the beginning of the show, there's little we can do to stop the ground from breaking up around us, but we can certainly assist when it comes to finding a more stable footing. It's for times like these that people buy gold and silver bullion. We talk about uncertain times. We talk about unprecedented times. We talk about governments having the ability to take things away at the touch of a button, whether it's our freedom of movement or our access to savings. None of these are what-if scenarios anymore. They're very real. And with that, it creates the need to protect your portfolio and your livelihood with the only time-tested safe haven assets that are gold and silver. To hear more about this, check out my full interview with Jim Rogers, to be released shortly, or head over to goldcore.com, your precious metals experts. And now for Chart Watch, our regular look at gold and silver through the lens of technical analysis. And this week, we welcome Patrick Karim of NorthStarBadCharts.com. Now, tell us, what on earth is going on with gold and silver at the moment?
Well, we're going through a turn. So this is the same type of turn. There's a lot of fractals, let's say, with 2008 type of move in the U.S. equities and the turn. But honestly, from the charts that I've gathered, we're closer to a 2000 type of turn. So we're not halfway through a bull era in precious metals. We're just starting a bull era in precious metals. And like, I have a chart I could show you.
Please do throw it up there.
Yeah, it's going to be the first chart is going to be a big picture chart, which will show you what's happening, what I see right now. So right here, I have this blue line right here is just the SPX, good old fashioned SPX. Right here, this one here is uranium divided by SPX. The black line is gold divided by SPX, or the gold to SPX ratio. And at the bottom here is gold chart. So I'll bring your eyes to what happened at the turn. So when SPX had a longer term breakdown line, which is less steep than usually the final melt up breakdown line. So here you have a clear 1, 2, 3, 4, 5, clear breakdown line from a pretty steep angle of ascent. So usually that's not always the first breakdown line, which is going to lead to like some crazy move down, because there's still upwards momentum. So once that's broken down, the upwards momentum slows down. If it slows down enough to break down from a longer term, less steep angle of ascent, then usually that is pretty much sayonara. So right here, I marked it up. So here is what I call the bearish transition zone, is right here when it breaks down from that first line all the way down here. That's when US equities, they're in a whole bunch of trouble. And I'll bring your eyes to today. Here's the sleep mode line. And what I think is happening right now is we're actually in the transition area from that melt up phase to trying to go at least test that early breakdown line, which could be the death knell for US equities, which is going to put them in a slumber for 4, 5, 6, 7, 8, 9, 10 years. Then I'll bring your eyes down at the bottom and I'll show you the precursor is in ratios. So let's say uranium starts refusing to do a new low versus SPX. So even if uranium, let's say the price stays sideways, at least it's not going down versus SPX. So that means relative strength, SPX is losing some of that currency supply, that money supply, or whatever, the capital flows. They're leaving more SPX than uranium. Gold, same thing right here. So that black line right here, you'll see that gold, when the SPX breaks down from that sleep mode line, gold versus SPX refuses to do a new low. So yeah, and you'll see gold kept going down a little bit right here. The golden, the yellow line, it still kept going down a little bit. So step one is gold has to bleed less than US equities. I'll bring your eyes to today. Here's the gold to SPX ratio, actually bottomed when that sleep mode line broke down. See the gold to SPX ratio. So gold kept going down, because here you see, everybody knows that gold, here's the gold line up here, kept going down, but it's bleeding less than SPX. That's step one. Step two is gold will heal ahead of the SPX. So while gold refuses to do a new low, eventually, I'll bring your, about halfway through, you see that little yellow line, it starts going up actually about halfway through. Gold is healing, but SPX, if you look at the top chart, keeps bleeding. And that is how gold prices in the required monetary imbalances that are going to be required to save US equities, to stop the bleeding. Gold prices that in ahead of time. So it's the same thing here. So right now, all we're waiting for is we're waiting for gold to actually start turning upwards and start healing ahead of US equities. So this is what's happening right now. It's like until the US equities are able to do new high nominally, the working theory is this is what is unfolding ahead of our eyes. And you have the gold, the uranium to SPX ratio behaving exactly the same way for additional evidence. So here you see uranium bottom versus SPX exactly at the same moment that it broke down. And look what it happened here also. January 22, when the SPX broke down. So you have supportive evidence, whether you think gold's manipulated or silver. Now you have two assets in the same class, commodities, real assets, bottoming, showing the same type of pattern that they did previously in 2000 when the US equities were starting to roll over.
Very strong correlation there, isn't there?
Yes. And that is, I'll show you. And I did a zoom in. So I was having fun for the past 10 since this bottom here. So the past 10 trading days, every day I've been updating this 1 hour chart of the gold to SPX ratio. So here's gold. It keeps going down. It's bleeding. Yes, guys, it's going down. It kept going down. But what I noticed back here, it was breaking out relative versus the SPX. So SPX was bleeding, but gold was also bleeding, but less. But look what happened. Day 1, day 2, bullish flags, day 3, 4, day 5, a back test, then day 6, 7, 8. What is this, David? It's an uptrend starting to build on the smaller time frames. And here, finally, gold is starting to wake up above. It's on the 1 hour chart, guys. I know we're not at the weekly yet or at the monthly chat, but this is what's happening. And then I zoomed out. So this is what it looks like still on the 1 hour chart. Huge base. Gold is now breaking out of a longer term pattern, a bottoming pattern versus the SPX. So this is super, super bullish in the sense that it's, if you go back to my step 1, gold is bleeding less. This is proving to you that gold is bleeding less than SPX. And step 2 is when gold starts on its own chart merit, starts breaking out. I'll come back to this chart. When it gets back above this, there's another trend line right here. When gold starts breaking out on its own chart merit, then that's game over for US equities. For like, they won't do a new high for 3-4 years, and they might get out of the rut in 8-10 years. So we're really close to a turn, David, and this is unfolding like.
I know these
right
are
before
longer term charts, Patrick, and you say we're really close to a turn. Do you want to hazard as to a time frame on that?
Well, look at this. So let's say this is the time it took. So on the breakdown, it took 18 months for really to gold to break out of its base, but it was climbing already. It's already started climbing. Uranium had great profits. So if you look at this, there might be by 2023, so maximum 10 months, this line here would have probably resolved and broken down below this early breakdown. Yeah, so I say close, but I'm looking at monthly charts. So add 8 or 9 candles. For me, it's short on the monthly chart, but 8 or 9 candles is actually for maybe the day trader. It's like a time frame. Oh my God, Patrick, you're so far in the future, right? But in the macro landscape, when you're trying to time a move that's going to generate 10 years of uptrend in your favor, 6, 7, 8 months is, for me, it's giving you just enough time to start preparing. If you haven't prepared before, you could really start looking at the charts and preparing. Like, let's say you're a fundamental guy and you want to start looking at, I don't know, miners or whatever stuff you like. This is a time you get, because that time's going to run out. That window is going to close once SPX closes below that early breakdown line.
Indeed. Turn our attention just to silver for a moment, if we could. Obviously, there's been increased in volatility in silver, and we've seen a breakdown below $18 an ounce. What are you seeing that's catching your eye in the silver market?
There, I'll put it on the monthly chart. Silver is a recovery metal, and you'll see that silver puts in important bottoms here. I have the the recessions overlaid, and look at that. Silver will bottom halfway when people, and we know like recessions are always backfilled, right? And then they backfill it, and then it keeps going on for a while. Look at the GFC crisis. Silver actually sensed the recovery while US equities kept going down halfway through, or even here, like silver bottomed in the abyss of the recession when people think it's the end of the world. Same thing here back in March Madness. So I'm pretty sure we're in a recession right now. I have and so silver, whenever it decides to bottom, we'll know that the recovery is starting to get priced in. And look at these levels. Like these levels, if you wanted silver to bounce, this is it there. It's this zone right here. It's like the end of the world. But I'll tell you one thing. We've always stated that silver has to get above like 28, 29, like for really to get activated. But for guys who are swing traders, this line here, if this is breached, this wake up line, there's probably going to be a fast move to go back and retest the 27, 28, 29. Then we'll know the truth if we're really like going to go
Carry on
rocket
through that or not.
Yeah, but right now it's like you're so close. You don't have to buy here, but please wait, guys, for at least this line to be breached. If it goes back above this, then it has a fighting chance. And there's a wall right here, previous support, turn resistance. So 2250 is going to be also a steep test for silver. But it's on historical support right now. It's like, yes, it could dip. Yes, if markets start rolling over, like I showed on the first chart, hard, silver could, go through, seep through that lower line. But it's closer to a generational bottom than it is to a generational top. And that's how you have to see it from a risk versus reward aspect is we're much closer to a bottom than end game type of top.
Closer to a generational bottom than a generational top. That's a great spot for us to finish up on. Patrick Karim, North Star Bad Charts. Thanks for joining us on the M3 Report. My thanks to Patrick Karim of NorthStarBadCharts.com, and you can find a link to his site in the show notes below. And that brings us to the end of this week's The M3 Report. If you've enjoyed this show, had a nap during the show, or want to share the show, please let us know either in the comments below or by tweeting us at @GoldCore or by using the hashtag TM3R. And don't forget to hit the notification bell to get notified for the next episode. That's all from me and the rest of the GoldCore team. I'll leave you with some behind-the-scenes footage of when I asked Jim some questions slightly off book.
My name is Jim Rogers. I don't have a job. I do support myself by investing. Well, the answer to your question is I got a summer job on Wall Street just after graduation, and I fell in love with Wall Street. And as soon as I got out of graduate school in the U.S. Army, I went straight to Wall Street because I had fallen in love with Wall Street and investing. Well, I guess read everything you can if you're going to be an investor. For instance, if you read the annual report of a company you're investing in, you're going to do more than 95% of the people on Wall Street. And Dave, if you read the notes to the annual report, you're going to do more than 98 or 99% of the people on Wall Street. So just read it and read it and read the competitors' annual reports and figure out what's really happening. Some people think it's boring and dull, but if you want to be a successful investor, be boring. Be boring and you'll be successful. The government knows what it's doing. Any government, very few governments in history have known what they were doing, and very few have gotten it right in any country in the world. I would abolish the Federal Reserve and resign. The U.S. has had, since we're talking about the U.S. has had 3 central banks in our history. The first 2 disappeared for a variety of reasons. This one's going to disappear too because they keep making mistake after mistake after mistake. So this one will disappear too. Well, it's not as though that all of a sudden heaven opened up one day and said everybody must have a central bank. No, central banks have not been around forever. The U.S. has not had central banks always. We can get along without central banks. But well, let's put it this way. We'll be better off than the present central banks we have in the world because they're so hopeless. Don't do it unless you know what you're doing. Don't make an investment unless you yourself know a lot about what you're investing in. Please, Dave, avoid hot tips. Hot tips will ruin you. Everybody wants a hot tip. Everybody wants to be rich this week. I want to be rich this week too. But I will tell you, hot tips will ruin you. Avoid hot tips. Stay only with what you yourself know a lot about. Well, I'm going to say in general terms, emotions, when you see everybody going nuts about a market, that doesn't, you don't sell that day. or if you see everybody totally despondent, if you see everybody saying, I'm never going to invest in stocks again as long as I live, it's all crooked and they're dishonest and it's all rigged. When you see that kind of emotion going on around and despair, it's usually a signal we're getting close to the bottom. And conversely, when you see people giving up their jobs to go into the stock market, it's, you know, it's usually hysteria. And so you should start thinking about getting out. I guess the lesson is to sell hysteria and buy panic.